This is going to be a series on how to buy property in the UK, specifically for first-time buyers. Hi, this is Mosh. Today I'm going to go through the different types of mortgages, how to figure out how much the bank would lend you, deposits and what loan to value ratio means, fees and costs, paperwork that you need, and hints and tips based on my own experience going through this process as a first-time buyer in the UK housing market. Before you do anything, you need to figure out how much mortgage the bank would actually lend you. Now, the rule of thumb is 4 to 5 times your annual wage. So if you're a single person and your annual wage is £30,000, the bank will lend you potentially £120,000 to £150,000. If you're a couple, then that amount doubles. However, the bank will always do an affordability check. So what they'll do is they'll look at all the income coming in and compare it against your outgoing costs. So things like credit card debt, loans, car finance will negatively impact that affordability check. It will reduce the amount the bank will be willing to lend you. What I recommend is you pay off as much debt, especially short-term debt, before you get a mortgage, as this will lower your risk to the banks. Because the more money extra you have in your bank account, the more money they can potentially lend you. Another thing to watch out for is if you're regularly going to overdraft. That shows the bank you're not good at saving money because you're always going in debt every single month. And if you have a mortgage, how are you going to support that additional cost? Before you apply for a mortgage, the best thing to do is stay out of your overdraft for at least 6 months. That should give you a rough guide of how much you can get from the bank. The next thing to do is actually get something called an agreement in principle. When you start looking at houses and put offers in, your estate agent a lot of the times requires you to have an agreement in principle. Otherwise, they're not going to let you put the offer down. An agreement in principle is basically how much you can borrow. So when you do it, you can go to individual lenders and all you have to do is put in your income and your outgoing costs. Be as honest as you can in this process. Based on all the information you put in, that lender will do a soft credit check. So it's not a full credit check, so it's not going to negatively affect your credit score. And they will give a realistic amount that you can borrow, assuming everything else checks up and all the details are correct. That is a more realistic figure than using the rule of thumb 4 times your annual wage. Let's say you've got your agreement in principle, you've got an amount. The next thing you need to start thinking about is the deposit, which is one of the most important things when it comes to buying a house, especially for first-time buyers. Now, there's something called a loan to value ratio, and this should act as your guide. So, for example, let's say we have a house that's £100,000. You have £5,000 saved up. So that means you're putting a 5% deposit and your loan to value ratio becomes 95%. So instead of £5,000, if you're to put £10,000 on a 100k house, your loan to value becomes 90%. The lower this figure is, the cheaper interest rates you get because it's less risky to the banks. And if it's less risky to the banks, they're going to offer you much lower interest rates. And I'll show you a couple of examples. So assuming the house price 100k, I found a mortgage with a loan to value ratio of 95%. The monthly payments come to £475 and you can see the interest. Now, if you were to put £10,000 to get your loan to value ratio at 90%, you can see the monthly payments become £399 because you're getting a lower interest rate. I'm ignoring fees for now, we'll talk about that later in the video. A 15% deposit, so you put £15,000 down, it gives you a loan to value ratio of 85%, that comes to £370. And you can see the interest rate is reducing. Because a mortgage is a very big loan, so it does really make a difference. Let's say we put £20,000 down to give us a loan to value ratio of 80%. The monthly payments come to £331. So you can see compared to putting 5% deposit down and 20% deposit down, the difference is saving £144 a month. So it really does make a difference. And you're more likely to get a mortgage with a bigger deposit and much cheaper rates. The next thing we need to talk about is the types of mortgages. A mortgage is just a big loan secured against your house. So what that means is if you can't repay or you come into financial difficulty, the bank can repossess your house and sell it on your behalf and take their money back. The 3 key types of mortgages are capital repayment, tracker mortgages, and interest only. It's highly unlikely you will get an interest only mortgage, and very few lenders do this anymore. Most first time buyers go for capital repayment. Capital repayment is where you're paying the interest and paying off the house every single month. Most lenders, especially if you're a first-time buyer, they will allow you to fix your interest rate for 2 to 5 years. And that makes it so much easier for you because you know exactly how much your monthly payments are. Now, after the fixed term, it goes onto a variable mortgage. That's where the interest rate changes based on the Bank of England's base rate. I would say if you get interest rate fixed anything less than 3%, that's very, very good because it's close to the rate of inflation, and the house prices in the UK generally go up 5% every year. And capital repayment, you know exactly what your monthly payments are for a fixed term. So for example, let's say a 100k house, you put down 20% deposit. So you need an £80,000 mortgage, which gives you a loan to value of 80%. In this example, you can see it's fixed for the first 2 years at 1.79%, which is really good. Then after that, it goes to a variable rate of around 5.7%. But again, this rate can change based on the Bank of England's base rate. Based on those figures, the total interest, assuming you had the mortgage of 25 years, the total interest you would have paid is £62,000, and after 25 years, you would have paid off £143,000, including that interest rate. My top tips, and these are things I wish I knew before I got a mortgage. Firstly, lenders will generally allow overpayment up to 10%. So for a 100k house, you can pay £10,000 off extra each year on top of whatever you're already paying. So that will massively reduce the interest you pay over, let's say, 25 years. One thing you have to be careful of, if you want to sell the house, there's an early repayment fee, basically an exit fee, which can be very, very expensive. This will apply to if you're in a fixed term. However, what some lenders do, they do something called porting. If you're buying another house, they'll just port the mortgage over onto your new property and keep that rate and that fixed term. And after the fixed term ends, I will always remortgage because you'll get a better rate somewhere else. Because once you're out of the fixed term, you can do what you want. There are no exit fees. Next up, we're on to fees when it comes to buying a house. From my own personal experience, I was a bit blindsided by the amount of fees there are and really the cost of those fees. So I'm going to go through them with you. The first thing is the arrangement fee. This is the cost of the mortgage and it can be very expensive. A lot of the times it can be £500 plus. One thing you can do is you can ask the lender to put it into your monthly payment. Also, one thing to be careful of, it actually might be cheaper to go for a mortgage with a higher interest rate with zero fees. Next up is the valuation and survey fee. So the valuation fee is the lender will come out and just to check that the house does exist and it's at the right value that they're giving the mortgage for. It's approximately around £250. Now, a survey is really for your own benefit. It can range anywhere between £400 to £700. This is a more detailed check of the house. So the surveyor will come and visit the property, make sure the boiler's working, check for any cracks or subsidence in the house, any damp. And this becomes especially important if you're buying an older house. And if the surveyor does find something, you can actually use that to negotiate the price down on that property. Next up is the legal fees, basically solicitor fees. They can range anywhere between £500 to £1,000. They cover the legal costs such as conveyancing and local authority searches on the property and doing all the other bits of paperwork. I actually use a solicitor the bank provided, but I would not recommend this. I would recommend using a local solicitor, someone that you can actually go and visit, because in my case, it was actually the solicitor that was delaying my whole process and not the actual mortgage company. And because they weren't in the local area, I could only phone across. Whereas I think if you go and visit a solicitor and you're in front of them, that will get them to speed up their work. Next is stamp duty, which is basically a land tax for the government. Now, for first-time homeowners, from July 1st, 2021 is 0% up to £300,000. During the pandemic, so if you're buying just before July the 1st, 2021, is 0% up to £500,000. After July the 1st, 2021, between £300,000 and £500,000 is 5%. And beyond £500,000, which is highly unlikely if you're a first-time buyer, but it does increase. So there's different levels to it. So the key thing is, if you're a first-time buyer, up to 300k, is 0%, which is really good because the average UK house price is around £240,000. Another cost I overlooked in my journey of house buying was the moving cost. So things like actually hiring a van or getting movers in to move all your furniture, redecorating. Obviously, when you're moving to a new house, you want to do a bit of redecorating, especially when the house is empty. So all those little things do add up and you have to take those into consideration. The next thing is paperwork. So I'm going to talk about all the paperwork you need when it comes to house buying. The first thing is if you're employed, you need 3 months worth of pay slips. And if you're self-employed, you need 2+ years of your accounts. You also need a proof of deposit. And this is where your solicitor will come in and check the money is not coming from fraud or an illegal source. So for example, if your parents have lent you some money or your friends and family, that will need to be classed as a gift deposit. Basically, when you buy the house, they're not going to try and claim that money back. It's a simple process. You just get them to write a letter saying that it's a gift deposit. They're not going to ask for the money back, sign and date. That's it, done. You're going to need at least 3 months worth of bank statements, your latest P60, and if you're self-employed, SA302 tax return. Remember, I'm not a financial advisor, so this is just my own experience and information that you can find on government websites that I'm giving you. All right, couple of additional points you need to think about. The first thing is how long should the term of the mortgage be? Generally, most people go for 25 years, but I think it's irrelevant. I think the longer the term, the better it is. If I was to go back, I'd try and push it to 30 or even 35-year mortgage. The reason is that lowers your monthly repayment. And every time the fixed term ends, I always remortgage to another lender for a much better rate. If you have the idea in your head that you want to get it paid off as early as possible, then you can go for a much shorter term. But remember, a lot of mortgages, they offer overpayments up to 10% anyway. So you always have that option. Now, some people ask, where do you find mortgage deals? You can go direct to the lender, especially if you've got your agreement in principle. You can go to a comparison site, or you can use a mortgage broker. A mortgage broker is a qualified person that can actually search for mortgages on your behalf based on your situation. Because they do this day in and day out, they can probably get you a very good deal and a mortgage based on your circumstance. Just be aware they will charge a fee. Now, the biggest pitfall you may have is if there's a chain. For example, if you wanted to buy my house and I want to sell it, but I need to buy another house to live in, and then the house I'm buying, those people need to buy another house, you can see the chain gets very, very long. It's all dependent on someone else selling a property and buying another property. For example, if you want to buy my house, and I want to buy another house, but that went or something happened or the mortgage didn't go through, then that will break the chain. Obviously, I can't move and then your mortgage gets cancelled because you can't buy my property. So when you're searching for properties, the ideal situation is where there's no chain. And a lot of estate agents will tell you if there's a chain or if there's no chain on that property. And if there is a chain, it can delay the process by weeks, sometimes months. Another thing I would recommend that you do is check your credit file before applying for a mortgage. You can actually check your credit file for free using the main guys are Experian, Equifax, and TransUnion. You will see a lot of the information that the banks and lenders see. And if you find errors, ask the lender to correct it, and you can put a notice of correction on your credit file as well. I hope this helped, and I will really appreciate a like if you got something out of this video.